Insert short audio clip. What if I told you that the entire modern financial system functioned on an infinite money glitch where billions, no, trillions of dollars were created out of thin air day after day, and at any point the whole system could collapse?
Okay, let's unpack this.
Yeah.
You just heard something that sounds like it belongs in a sci-fi movie, maybe hacker's wildest dream, an infinite money glitch.
Mm.
But what if that glitch isn't really an error at all? What if it's like the actual foundation of our whole financial system?
Yeah.
Welcome to the deep dive. Today we're diving into fractional reserve banking. Now, I know many of you know the basics, but it hides some truly surprising stuff.
It really does.
Our mission really is just to cut through the jargon, figure out how money is actually created, what that means for the economy, and, for your wallet. We've pulled insights from all sorts of places, explainers, academic talks, trying to get the full picture.
It's fascinating, isn't it, how much the system touches our daily lives, but how few people really grasp the mechanics, the real implications.
Yeah.
What most people think about money creation is often, well, it's pretty different from the institutional reality.
Right. So let's start with that core idea, money seemingly appearing out of thin air. We know banks don't just stash every dollar you deposit in a big vault somewhere. That's fractional reserve lending.
Mm-hmm.
And the basic idea, I think most listeners get this, is you deposit, say, $10,000.
Right.
The bank keeps a fraction. Traditionally, it's been around 10% here in the U.S.
Right.
And then it loans out the rest, maybe $9,000. That $9,000 gets deposited somewhere else. That bank loans out 90% of that, and it keeps going.
The cycle repeats.
Yeah, so on paper, that first $10,000 could, theoretically turn into $100,000 floating around the banking system. It feels like a chain reaction, but there's a really key difference, isn't there?
Precisely. And this is where the common understanding often kind of bumps up against the reality. Looking at various analyses, including some economic deep dives, the critical point is banks aren't just reloaning money that already exists. When a bank makes that $9,000 loan, they don't physically take cash from your initial deposit. What actually happens is new money is, created right into the borrower's account.
Just like that.
Pretty much. The bank takes the borrower's promise to repay the promissory note, and in return, it issues new credits. Those credits are new money, basically conjured into existence on top of the original $10,000.
Wow.
That's why you hear economists talk about the money multiplier. A little bit of reserves can actually generate, many times that amount in new money. Like $100 in reserves could eventually back up $1,000 in the money supply.
That's pretty incredible. So not just moving money, but genuinely making it.
Yeah.
But then, okay, if money is just being created out of nothing, or maybe more accurately, out of debt,
Yeah.
what gives it value? What stops it from being worthless?
That's the million-dollar question, right? Or maybe the trillion-dollar question these days.
Wow, yeah.
The sources we looked at offer a pretty profound answer. The new money essentially borrows, or you could even say steals, value from the money that already exists.
Okay, explain that, like diluting something.
Exactly, like diluting something. Think of it like a pie. If you suddenly double the number of slices, but the pie itself doesn't get any bigger, each slice is naturally smaller, worth less.
Right.
So when the total amount of money grows, but the actual stuff to buy goods and services doesn't keep up, then each dollar just buys less. And that, of course, is inflation.
So inflation isn't just some unfortunate side effect. It's almost baked into the process.
In many ways, yes. Some analyses flat out call inflation a hidden tax on the public. It eats away at your savings, your purchasing power, without you necessarily seeing a deduction on a payslip. And beyond that, this constant expansion of credit, as some sources point out, can fuel those big boom and bust cycles we see, mess with prices across the board, and even link to unemployment sometimes. People feel like they have to borrow more just to keep up.
Which brings us to another really mind-bending idea from the research, that money is debt. Every single dollar, every number in an account is basically an IOU from someone to someone else.
Yeah, fundamentally.
The only way money actually comes into being in our system is through loans. It's wild when you think about history. Back in 1835, President Andrew Jackson actually paid off the entire U.S. national debt.
A rare moment.
Right. And if, just hypothetically, all debts everywhere, government, corporate, personal, were somehow wiped clean today, the financial system would just stop because there'd be no money left. It's a crazy paradox.
It really is. And it connects to another tricky part of this, interest.
Ah, right. Interest.
When money is borrowed, you almost always have to pay it back, plus interest. But here's the catch. Only the principal, the original loan amount, is created in that initial transaction.
So where does the interest money come from?
Exactly. It doesn't exist yet.
Yeah.
Not from that initial loan anyway. This built-in shortfall means more money has to be created later through new loans just to cover the interest payments on the old loans.
So it's a perpetual motion machine of needing more debt.
It fuels this constant cycle of expansion and, well, inflation. Some sources argue this makes defaults and bankruptcies almost inevitable. Part of the design, you could say.
You're saying it's like it's rigged from the start, that someone has to fail.
That's the argument some make. Think of it like that game, musical chairs.
Okay.
If the money to pay all the interest literally doesn't exist until more borrowing happens, then eventually the music stops and someone's left without a chair when the debts come due.
And that tends to push wealth upwards towards the banks?
Over time, that can be the effect, yeah. Transferring wealth from people struggling with debt towards the institutions at the center of money creation.
Wow. Okay, that sounds incredibly unstable, almost like a scam if you listen to some critics. So if it's got these like built-in flaws, how does it actually function day to day? Why isn't it just constantly collapsing on itself?
It does sound chaotic, doesn't it? But look, the reality is while it has these vulnerabilities, the system is also incredibly managed. It's maybe less like a fragile house of cards and more like a really complex engine that needs constant tuning by experts.
So there are controls in place.
Oh, absolutely. This fractional reserve system, remember, is basically how almost all modern economies work. The Federal Reserve, the central bank, is crucial here. They set those reserve requirements we talked about.
Right, at 10% or whatever it is?
Yeah, though that specific number can change, and sometimes it's effectively zero now, believe it or not. But they also do these stress tests on banks, simulating crises to see if they'd survive a bank run.
Trying to anticipate problems.
Exactly. And things like FDIC insurance, insuring your deposits up to a certain amount, that's a massive psychological safety net. It keeps people from panicking and pulling all their money out at the first sign of trouble.
So the central bank isn't just letting this money glitch run wild. They're actively managing the potential fallout.
Precisely. They step in constantly. For instance, think about Christmas shopping season. People pull out a lot of cash, right? That could technically shrink the money supply and cause problems.
Right.
So the Fed often injects extra reserves, extra liquidity into the system to counteract that temporary drain. Then after the holidays, when deposits flow back in, they might pull some of that extra money back out.
Okay.
So yeah, while the core mechanic of creating money from debt is there, central banks have developed pretty powerful tools to steer the ship, manage the money supply, and try to keep things stable. They're trying to stop that musical chairs game from ending too suddenly for too many people.
It's clearly a very delicate balancing act. But
Yeah.
even with all that management, the underlying risk, it's still there, isn't it? That feeling of financial dominoes just waiting to fall. It makes me think of that old movie, It's a Wonderful Life.
Yeah, the bank run scene.
Exactly. Where George Bailey's trying desperately to explain that their money isn't sitting in the vault, it's in Mrs. Smith's house and Mr. Jones's business. But what happens if Mrs. Smith and Mr. Jones can't pay it back? Or if everyone just loses faith at once?
And that's not just old movies. We saw it happen for real. And quite dramatically. Look at Washington Mutual WAMU back in 2008.
Oh yeah, I remember them. Huge bank.
Huge. The biggest savings bank in the U.S. at the time. But in the panic after Lehman Brothers failed, they had what people called an online bank run. Depositors pulled out something like $17 billion in just 9 days.
$17 billion. In 9 days.
Yeah. Nearly 10% of their total assets just vanished because people lost confidence. And 2 weeks later, WAMU was gone, seized by regulators. It shows how fast trust can just evaporate in the system, even with all the safeguards.
That's sobering. So, okay, how exactly does the Fed do that injecting and draining of money you mentioned? How do they exert that kind of control?
The main tool is something called open market operations. It sounds technical, but it's surprisingly direct. The Fed essentially creates new money, literally, just digital entries, keystrokes in cyberspace, as one source put it, and uses that new money to buy things, usually government bonds, from commercial banks.
So they just invent money and buy bonds with it.
Pretty much. There was this one example cited where a small team at the New York Fed, in just 45 minutes, bought $7.8 billion worth of treasury bonds.
Wow.
And because of that money multiplier effect we discussed earlier, that $7.8 billion injection of reserves could potentially lead to the creation of maybe $77 billion in new money throughout the wider banking system.
That's astronomical power, creating reserves for banks out of thin air.
They are truly the banker's bank, with this unique ability to expand or contract the base layer of the money supply.
It really is incredible when you lay it all out. The power, the paradoxes.
Yeah.
This whole deep dive shows just how weird our monetary system actually is. And it makes you wonder, okay, if this is how our current system works, what about these new kinds of money people are talking about?
That's a really important connection to make, because some of the alternatives proposed directly address these issues we've been discussing.
Like what?
Well, some sources mention ideas like full reserve banking. That would mean banks have to keep 100% of deposits on hand. They couldn't create new money by lending out deposits they don't technically have.
So no more money multiplier.
Exactly. The argument is it would stop that inflation engine and maybe smooth out those boom-bust cycles. Another idea is separating banking functions completely.
How so?
You'd have, like, deposit banks that just safely store your money for a fee, no lending involved with deposits, and then separate loan banks that lend out their own capital or money raised through long-term bonds, not demand deposits.
Trying to firewall the basic deposit safety from the riskier lending side.
Right. More transparency, maybe more stability.
These are some pretty radical shifts from today's system, and it brings us to maybe the most provocative thought, especially looking ahead. Central bank digital currencies. CBDCs. What's the take there?
Ah, yes. CBDCs. This is where things get really interesting and maybe a bit concerning for some. Some analyses suggest CBDCs could give central banks unprecedented, like absolute control over money.
How? Because it's all digital and tracked?
Partly that, but also because the technology could allow for programmable money.
Programmable money. What does that even mean?
Imagine money that could have rules embedded in it. Maybe restrictions on what you can buy or where or even when. Or money that automatically loses value over time to force you to spend it. There's historical precedent for that idea, sometimes called Schwundgeld.
Wow, so money that expires or can only be used for certain things approved by, well, by the central bank.
Potentially. It's described as giving the central planner new instruments of control. It raises huge questions about liberty, privacy, economic freedom, even the definition of money itself.
Yeah.
If money can be programmed like that, can it still be a reliable store of value or a truly free medium of exchange? It's definitely something we all need to think about as this tech develops.
Absolutely. Whether we're talking about the infinite money glitch running our economy right now or the potential futures offered by digital currencies, understanding how money works, how it's created, and who controls it, it's just incredibly important for everyone. This deep dive really peeled back some layers on how complex and, frankly, how counterintuitive it all is.
It certainly is.
Well, if you found this deep dive as fascinating as we did, please do follow, like, and share the podcast. It really helps us out. And hey, for even more insights on financial systems, Bitcoin, and everything in between, make sure you're following What Bitcoin Taught Me on all the platforms. Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. We'll catch you on the next one.